Well, those looking for international exposure have found it fruitful to go long Indian equities. In fact, the Sensex recently closed at an all-time high. This as Chinese equities have languished. We hear a lot more about the Chinese growth story, but over the last couple of years, the stock market has struggled, and buying India and selling China has been a fruitful pair trade. Recently, and I am talking very recently, you've seen those Chinese equities perk up. Is the narrative changing? Let's bring in Thomas Mathews, senior market economist at Capital Economics. Thomas, thanks so much for being with us. This is kind of one of those market themes that are floating out there, especially with respect to emerging markets. Is it time for maybe a reversion to the mean or reversal of that buy India, sell China trade?
Yeah, look, it's always hard to pick the turning points in these narratives, isn't it? And I think there's certainly been very good reasons to be long India and short China over the past couple of years. But I do think maybe now we are starting to see that narrative shift a little bit. Reversion to the mean might be a bit strong if you think how high the mean was for China even a couple of years ago. But certainly we could be in for a period where maybe Chinese equities at the very least stop struggling quite so much and maybe start to rebound, I think.
And I guess, is the call for Indian equities to come under pressure or just to moderate?
Yeah, look, I don't think they're going to come under too much pressure. You do see, stories out there, worries about, high derivatives trading, retail volumes, all sorts of things that people start to worry about when the market's in a bubble. But the fundamental narrative about Indian equities, I think, is an absolutely right one. Right? The economy is growing really well. From an investment point of view, the political risks are low. The story is more, well, a lot of that is now priced in now. You look at how far earnings expectations for Indian corporates have risen, and they've really priced in this big acceleration in earnings growth we've seen now. You look at how high valuations are there, and again, the very high risk premium in India seem very low. There's no real reason, in my opinion, for that to turn around in the near term. But you just might wonder how much more boost can those factors give to the market at this point with so much good news already priced in.
The U.S. is only fighting a trade war with one of those countries while embracing the other. And I wonder if that puts some structural pillars around India in a way that makes China vulnerable.
Absolutely. And I think, that's a very much something that isn't likely to change. I would say probably regardless, by the way, of who wins the upcoming election in the U.S. later this year. Obviously, maybe one candidate might be a bit worse than the other from the point of view of an investor in Chinese equities. But the reality is those tensions are going to be there for a while. And that's one reason I think not to expect the valuation of China's market to return back to where it was in, let's say, 2021 or anything like that. But where you are seeing a bit more positive story on China isn't from the international front, it's on the domestic front. A lot of the reason that the market struggled there is because of the almost antagonistic relationship that the country's authorities have with some of its private sector. That is where we've started to see a bit of a turn. And that's one reason why I think we've seen the market perk up, as you said, a bit more recently. It's very clear that the authorities have been worried about how far stock prices have fallen, and they're starting to unwind some of the policies or, try to reduce compliance costs for tech companies, reduce some of that downward pressure on stock prices. And that's something that I think could keep going perhaps over the rest of this year.
There is, a thought, and it's statistically borne out on U.S. election years, how positive that is for U.S. markets. India will be going through its general election, a multi-month process. Do you think, I know it's different and probably difficult to historically benchmark, but just given that the incumbent is incentivized to see a good economy during that year, is that also a boost for Indian equities?
Possibly, but I think it's worth noting, as you say, it is different. One reason it's different in emerging markets is often that elections come with big fiscal splurges that are actually bad for the stock market rather than good for it. Now, I don't think that's a risk in India this time around. As you say, the sort of incumbent is so well entrenched, there's not really any need for that sort of thing. But equally, it's hard to see how much more of a boost they could give either, because the economy is already going so well, because risk premium and India's specific risk premium are already so low. I think it's hard to see how they could give much more of a boost. But as I say, not really much downside risk that you might normally expect in emerging markets either.
All right.